So I'll start with my quick introduction. I'm Hash, the guy with laser eyes. And we are going to talk about real-world assets today. So with that, I would like to invite our panelists. The first one is, as you can see, Ariel.
Thank you. Well, I'm Ariel Scaliter. I'm the CTO and co-founder of AgroToken. We are an infrastructure to tokenize commodities and natural resources. We work in Latin America, Brazil, Argentina, and we are coming to the United States during this year. We tokenized the last semester soybeans, corn, and wheat, more than $100 million. And we have the expectations to tokenize $1 billion during this year. So that's what we do.
Thanks, Ariel. So as you can see, I wanted to talk about real-world assets, but we have found 4 speakers who are really experts in this from all over the world, starting with someone from Argentina. We have someone coming from Dubai just to attend this panel. But the next one is coming from New York City.
Hi, I'm Andy Chatham. I'm one of the co-founders of Demo. We're bringing the automotive industry on-chain. We have a mobile app you can use today to create an on-chain identity for your car and start collecting data from it. It's called Demo Mobile. You can download it on iOS and Android. We have about 10,000 cars connected to the network today. We've been building it for about 1.5 years, and just interested to hear some other perspectives on the space and learn more about the real-world asset category.
The next one, as you can see, is Nick. Nick is coming from Florida, from Fortunafi.
Good morning, everybody, or afternoon. Very nice to meet everybody. My name is Nick Garcia. I'm the founder and CEO at Fortunafi and Space Whale Capital. What we focus on is tokenizing the traditional financial asset market. We focus on traditional fixed income assets. If you might be familiar with revenue-based financing, traditional commercial lending, and a variety of different assets, both private and publicly traded. Our main focus is creating better collateral on-chain for stablecoins. So we partner directly with stablecoin issuers like MakerDAI, and we use the senior tranche of our real-world asset securitizations to mint new DAI into existence. And we convert that DAI into dollars, and that's what we're lending to traditional financial institutions. And the main focus here is really providing a more efficient cost of capital and a more efficient solution to scale stablecoins on-chain.
Great. So far we have heard agricultural products as an asset. We have heard automobiles and the data as an asset, and then we heard financial assets. And now it's the time for the biggest asset that exists on this planet. Any guess? Like in size, the biggest assets is the ships that carry cargo across the world. So Captain Vikas Pandey.
Good afternoon, ladies and gentlemen here. I'm Captain Vikas Pandey. I'm basically a master mariner by profession, and from last 10 years, being very active in the traditional and startup ecosystem for investment, and 2018 got into the blockchain and crypto space. In 2020, we came up with a solution for investment into ships by the normal people. So ShipFinex is our platform where anyone and everyone can participate into this alternative investment class, which has been existing for hundreds of years and responsible for the 80% of transportation across the globe. So that is ShipFinex.
Thanks, Vikas. So basically, RWAs are simple in understanding that, okay, some asset that it doesn't exist on chain, but we try to bring it on chain so that we can trade it more freely, and there are other advantages. So now my question for, it's simple, but the question for all of you is, basically in this section, and let me tell you, like this whole panel discussion we are going to have in 3 sections. So introduction is 1 section. Now we are talking about what can go wrong. So when we are trying to bring these physical assets or financial assets on chain, there are multiple things that can go wrong. And I spend a lot of time trying to ask each of our panelists 1 question that can go wrong, which I believe with them. So I'm starting with Fortunafi. And my question for you, Nick, is how do you handle bad debt? Like if a borrower uses your platform, borrows the money, and then they just don't pay, what do you do?
I think the easiest example here to give is think of your traditional mortgage, right? You stop paying your mortgage loan, and what happens? Well, the bank's going to take your home, and they're going to auction it, and they're going to get recourse back on that loan, and they're going to use that to pay the bad debt. I think one of the biggest tricks in real-world assets that's required to properly scale is the actual proper reflection of these changes off-chain, on-chain. How do you actually make these assets truly trustless to the extent possible on-chain? And I think there's three core things that solve that we haven't seen yet in the market, but I know is coming. I know we're working on it specifically. It's the custody of these assets. They need to be custodied by high-quality third-party institutions. The underlying cash flows of these assets, they need to be processed by third parties and paid directly on-chain. And then also the mark-to-market of these assets. So the biggest issue with there being defaults and discrepancies and mispayments off-chain and that not being properly reflected on-chain and having an improper mark-to-market on these assets, which then cause a lot of issues on-chain. So solving these three core elements of custody, payment, and mark-to-market of the underlying assets is core for real-world assets to scale.
Makes sense. So I noticed you said third party like 3 times in your answer. I'll use that as a segue to my next question, which is so third party is basically oracles, right? Third parties, oracles, right?
I wasn't referring to oracles, but oracles are another third party that come involved with that mark to market, right? So how do we actually properly pass the valuation and the value of these assets on-chain through the oracle? That's another thing that is required to scale this. And that's what I was referring to with the mark to market, right? So it needs to really, we're implementing on a solution with Chainlink where we have third-party attestations which are providing the price feed for Chainlink rather than it coming from the issuer itself like us. So it's providing a lot more trustless experience for those 3 core aspects of the real-world assets.
Okay, so I'll dig a little deeper into like how do we make sure that we trust those third parties and they are like trusted third parties are really trusted third parties, and that's the question for Ariel U, because I know Agro Token uses a lot of oracles, right, for issuing the like valuing the assets and all that. So how are you making sure that your oracles remain honest?
Well, first of all, everything can be wrong in real-world asset tokenization, because to define that you have the cryptographic representation of a real-world asset, you have to be sure at all the time that you have price, you have existence, and you have liquidity. If not, it's difficult to represent a real-world asset. So in our case, the proof of existence have to be demonstrated with a delivery grain. So we need the oracles, the Cargill or grain handlers, to be the oracles that can demonstrate that that grain exists. But because we work with biological assets, it's more difficult because we cannot find a particular soybean in a silo. So we have to work with the documentation. So because the commodity market is a very regulated market, we use all the actual documentation and legal procedures to be sure that we can demonstrate all the time the proof of existence. We use the contract between farmers and oracles to demonstrate the proof of liquidity. And we use a lot of technologies to demonstrate the proof of origin, because it's important in the commodity market that you be sure that the grain that you are tokenizing come from a legal farm. So, and sustainability, of course, is another attribute. So what we are trying to do is to add a layer, a digital layer to the actual procedures, because we cannot invent new proof of existence, new proof of liquidity. We have to use what exists and do more transparent and simple to use.
Thanks. So you said you use some sort of technology. I'm just curious, were you talking about some IoT devices?
Well, for we tokenize delivered grain, we tokenize future grain, and we tokenize perpetual grain. That is synthetic, of course. But when we tokenize future grain in Brazil, for example, you have $200 billion per year in loans with a promise of grain. We talk about future grain in this case. And the only way that we have to know if the hope of this grain is growing is with IoT and satellites. So yes, we use a lot of technologies to demonstrate the hope of the proof of existence.
Nice. This reminds me of a DCI project long ago, which was doing something with grain in Latin America, and they were using Bitcoin network for that validation using IoT devices. And Andy, I guess you use a lot of IoT, right?
We do.
So my next question is for you. You have these IoT devices that you put in the cars for now, right in your hand, and then you capture all the data, and then you are putting that data on chain. My question to you is, what if manufacturers, like Tesla, for example, somehow they start blocking using those devices on their vehicles? What do you do?
So Tesla is an interesting use case. About 25% of the vehicles on our platform today are Teslas. They're the easiest to connect because they have a fairly open API. So if you own a Tesla and you're in this room, you can log in using our app in about 2 minutes and start collecting and saving your own copy of the data from your car and use that with third-party apps that are built on top of Demo today. And they actually have made it more difficult to use the universal port that's present on most vehicles to collect data with hardware. So we're actually getting the data from their servers, not from the vehicle itself. And other OEMs, because of right to repair laws and generally just the need to be able to diagnose issues in the vehicle and pull data from them for their own diagnostic purposes, are really prevented from preventing users and owners of the vehicles from accessing their own data. And that's something that we leverage quite heavily in the design of our system, whether we're pulling data from a software system or directly with our hardware device. And the bottom line is that if they prevent people from accessing the data from their cars, they're making their products worse. And people want to access that data, and there's lots of benefits to being able to use it, whether you're getting a cheaper loan for your vehicle or a cheaper insurance policy or titling and registering it more effectively. The benefits to opening up access to that data vastly outweigh the potential costs of keeping it closed. So that's kind of the game theory that we're leveraging. And everything we've built up to this point, we've built without having to ask an OEM for permission, which is kind of a rule that we set at the beginning. So we are operating in this constrained environment that we created for ourselves. But now the OEMs are starting to reach out because they're realizing this is something that can actually benefit the people who have purchased our vehicles. Having an open developer platform on top of the car makes it more valuable to end users. And so that's something that we're leaning into very heavily.
Nice. You talked about some rules and regulations that probably will stop manufacturers like Tesla from doing things like that. Can you elaborate on that a little bit?
Yeah, I mean, Massachusetts has really actually been at the forefront of pushing right to repair legislation, and some people in the room might be familiar with that as far as requiring OEMs to make diagnostic information available to independent mechanics, and that's something that we obviously believe in quite heavily. And we think that the market will really take care of that issue on its own because nobody wants to buy a vehicle that's essentially a black box. Everybody's kind of had that experience with their iPhones, I think, where after a couple of years, the battery starts to fail, and you kind of realize that you've been pushed into this upgrade cycle. And we think cars are kind of heading in that direction a little bit, especially as they're obviously becoming electric and more connected. And we think accountability and opening up the access to that data is really the only way to hold OEMs to a higher standard and make sure that they produce better products for consumers, and that consumers are ultimately in control of those vehicles, especially when they're getting over-the-air updates and have battery systems that are of unproven quality, especially once you get past 100,000 miles in the car. So we think transparency is sort of the best ingredient to sprinkle into that market, and it's an absolutely massive market. So if you can even increase the value of a vehicle by just a couple percent, like spread out over the entire population of cars on the road. That's trillions of dollars out there waiting to be captured as far as value for consumers. So,
Interesting. Talking about the legal aspects of, like, we know that RW is very closely compliant with all the compliance set by the governments and regulators. Your case, Vikas, is interesting in that aspect because ships are, they go all over the world. It's very hard to pin them down with rules and regulations of one certain country. So in your case, if you say tokenize a ship on your platform, and maybe I'm the ship owner, now I take money from all these people, all these investors, and then I sell the ship to someone else, and I run away with all that money. How do you protect your investors? What do you do?
Very interesting question, Hash, because first of all, as you said...
I've thought about it. This.
Yeah. So as you know that the vessel is very highly regulated by International Maritime Organization. And because a ship or a vessel has to keep on moving across the globe, they have to maintain very high standards as well. So practically talking, this particular industry is very highly regulated. Second thing, when you say a ship owner can sell the vessel to anyone, okay, so a vessel is not something which is a car of $100,000.
So take a pause here. When he says vessel, it means ship.
Yeah, so, sorry. So because we define it as a vessel on our definition. So a ship, when it is being sold, it's not something which is a very low value. Generally, a vessel or a ship values from $15 million to $300 million, depending on the kind of asset it is and what it is trading. So selling this asset involves a lot of steps and procedures where there are law firms involved. A buyer who is buying this asset has to undergo a lot of due diligence process of the ship owner who is selling it. And similarly, a ship owner who is selling it has to give a lot of paperwork to the law firm who is actually executing this sale. So practically talking, it is highly impossible that a ship owner can sell the vessel or sell the ship on the sideways without informing anyone.
What if someone still does it?
Okay,
it's not 100%.
Exactly.
Yeah.
So it's highly impossible, but yes, that's very true. That if somebody does it for the sake of doing it and somebody bought it and transferred the money to that ship owner, what we can do is, because a ship is basically trading globally. So as soon as the ship enters into a port or a jurisdiction, the investors who were owning this asset as token holders, and we as a platform, ShipFinex, signs an agreement with the previous ship owner who has put the vessel or tokenized on our platform. He is binded by that legal agreement, which has been drafted by the world's largest maritime law firm, Stephenson Harwood, who is our partner. So we can legally put the lien or arrest the vessel where it enters after we came to know that this particular asset is being sold without the consent of the existing token holders. So it's basically what he did is illegal, and for stopping this illegal activity, we have already drafted the onboarding form and terms and conditions, what he is doing before putting the vessel on tokenization. But still, if he does it, he's definitely, the vessel can be brought into the custody, and the existing ship owner who bought it, he cannot trade that asset now.
So basically your short answer is that the moment the ship enters a port, you will hire a lawyer and go get it arrested. And then the matter will be in court sub judice, and then the court will decide because you have the agreement.
Absolutely correct.
All right. Makes sense. So I'm done with this section where I was looking at what can go wrong.
Hash, I would like to add something here, because you were talking about third parties when Nick also mentioned about the third parties. We also face one kind of challenge when we were starting, when we started this particular platform, was the value of the asset. Because somebody can perceive my asset value is $15.5 million, and somebody else can perceive that my asset is $16 million. So while putting the asset on the platform, what we do is that we have partnered with one of the major and the biggest asset value third party, which is called vessel value. They are existing in the market for quite long, and they have 104 parameters, algorithm by which they decide the value of the asset every 15 minutes. This was not existing before when I was sailing like 10 years back, and even 5 years back, this was not existing. And that has made shipping as an asset highly tokenizable, because the value is driven by algorithms, which are 104 parameters that decide the value of the asset, and it can be done every 15 minutes. Because, for example, soybean, for example, grain, the market goes up and down. Similarly, the ship which is carrying grain or soybean or coal or iron ore, this is also one of the reasons how the ship value goes up and down, the demand and supply. So this was not existing before. With us coming now, because of the vessel value, we have the dynamic API connected, and the vessel's value can change every 15 minutes, you can see.
Nice. So another example of using oracles or trusted third parties for RWAs. My next question is a quick short answer, like which L1, L2 blockchains are you guys using, starting from you, Ariel?
Well, remember that I'm the CTO of the company. I don't like the layer 2, okay? That's why it's not easy to say that, because it's not easy to find layer 1 blockchains to make possible to buy a Frappuccino in Starbucks with 0.021 tons of corn, okay? Because the Frappuccino costs $8 or whatever. So I think that we are going to a multi-blockchain system, okay? We are multi-blockchain in particular. If we are talking about commodities, we will move in layer 1 blockchain, because each transaction is important. The process that you have to do to liquidate, to fix the price of a grain is important. So we cannot lose trust because the technology that we use. We have to maintain the trust and the security all the time. So right now, in the state of the art of the technology, we use layer 1 because the security and the cost in some cases, yeah.
Very interesting, multi-blockchain solutions. You, Andy?
Yep, we create vehicle identities and do rewards distribution today on the Polygon proof of stake chain. And we've built the project to be able to scale and migrate to any other blockchain as needed in the future, and are closely watching the development of new L1s and L2 chains, side chains, whatever you want to call them. But closely watching that development as we add more vehicles to the network. And the goal is to be able to support every car in the world and give it an on-chain identity, and also have hundreds of millions of users. And obviously we're quite far away from being able to do that with the technology that exists today, but we see a pretty clear path towards getting there in the next 3 to 5 years.
Both of you sound very non-committal to any particular chain.
Yeah, it's not something that we see a lot of value in being very prescriptive about today, because the landscape is changing very quickly. And in our world, we're actually bridging a lot of existing things that are controlled by governments or large institutions like automakers, such as the VIN number of the vehicle and the title and registration systems that exist and proof of insurance, and all of those things are likely to exist on-chain in some fashion, and we're looking for kind of the right alignment and strategic value when we're talking about migrating something like this into another chain in the future. So for us, we have a lot of kind of different requirements when it comes to what needs to exist and transaction throughput and that kind of stuff.
Yeah, makes sense. You, Nick?
Yeah, I think my quick answer on multi-chain is that it really just depends on the use case, right? So, if speed is really important, or cost is really important, or liquidity is really important, or security is really important, that will sort of direct where you really want to be building on. I think RWAs in particular are a bit unique in that sense, that their best use case is most likely to be multi-chain. So we are currently built on Ethereum. Obviously, it's, I think, the most secure EVM chain by a long shot. But what we're seeing is insane amount of demand for RWAs on other chains, right? Just given the landscape of assets currently live on EVM, there is a huge demand for higher quality assets, more stable assets, assets that can be used in different financial instruments as well. So we started on ETH because of existing DeFi ecosystem. We work with MakerDAO, they're natively on ETH, so that's really where we started. But we have a world where our securitizations themselves are actually cross-chain, where we can tokenize securitizations and have underlying senior and junior tranches on different chains. And what we're seeing is a lot of demand specifically coming from Arbitrum, Solana, Binance Smart Chain, Polygon, like these guys are mentioning, Optimism as well. And really, I think the way to think about it from an RWA perspective is, where is stablecoin liquidity today? And primarily that's still on ETH, and then Arbitrum and Polygon and a few others after that. And really, I think RWAs thrive where there is more mature liquidity. So being cross-chain in nature is a huge advantage in the RWA space.
Thanks. Vikas?
Yeah, I would agree to Nick here. Essentially, what we are doing right now is we are using ERC 1400 protocol for marine asset tokens because ERC 1400 protocols allows you to sit on the cap table and be the real owner of that particular ship. So at present, we are using ERC 1400, but yes, we have built our system in such a way that because every ship is a different token on our platform, we are not going to stick to one chain. We are exploring the possibilities of other blockchains as well, layer 1, which can be utilized. So at present, ERC 1400, and layer 2, what we're using is Polygon, obviously because of the low cost to the investors.
Nice. So you talked about ERC 1400 tokens, which is relatively a newer standard, and that makes me think about these two scenarios where I'm talking about which direction the underlying tech for real world assets is moving. One is a more decentralized future, probably the same as it is today. You still keep using public blockchains, permissionless, but because the nature of real world assets is that at some point you need some permissions. You need to do KYCs, you need legal compliance. So people can come up with these new ERC standards that can help you with that. So that's one end of the spectrum. And the other end might be where people are now talking about RWA chains, which are supposed to be RWA chain, which are supposed to be more permissioned. And people are saying because the whole nature of RWAs is somewhat permissioned, so why not just use a permission chain to make things simple? What do you guys think about this?
Well, I think that the problem is if you create a platform, custody or not custody. I don't know if you cannot use permissionless blockchain. We use permissionless blockchain. The problem is that because you need KYC and other things, because of course you cannot make a loan for a farmer to buy to John Deere tractor if you cannot demonstrate where the funds come from, because you will never buy the tractor, okay? So I think that what we are working is we expect to use all the layer 1 permissionless blockchains with a kind of mixed custodial technique. So we can be sure that we can control the product, the transactions, the KYC, etc., but we never know the private key of the customer because we encrypt that information and give the user the possibility to have their own keys. So we need better UX. So we cannot do anything. We can create this bridge between the Web 2 and Web 3, and that takes time. So this is our strategy. We want to use permissionless
Interesting.
blockchains.
So you are moving more towards, you prefer permissionless end of the spectrum. Others, feel free to pitch in. Yeah.
I'll jump in quickly. I think it's important to note that you can do permissioned actions on open blockchains, right? I think, like we've discussed, the purpose of real-world assets is really to find liquidity on chain. Permissioned blockchains, closed-end blockchains, there's been a handful of examples. These things are not very good, to put it lightly. You can't bridge things cross-chain, you can't really validate anything, you can't really trust the state of the chain, and liquidity is highly fragmented in crypto. So it moves across blockchains. I mean, we've seen the growth of liquidity of stablecoins in particular on Arbitrum over the last couple of weeks. It's been insane. It's gone to the number 2 spot. So to have open public blockchains and to enable different parts of products that need to be KYC'd in order to access is a future that we're already seeing being built. So I think it will be on the public blockchains.
Nice.
Similar in our case, like what we are doing, like all these marine asset tokens, you cannot buy unless you do the KYC. So it's a permissionless blockchain, ERC-14 standard, but we are using the KYC of the person because he's buying an asset which is basically physically moving. So we definitely need to know that the person, who is he? So we are using a permissionless blockchain, adding the KYC or identity to it. So it's definitely possible. So why to go for a permission blockchain?
Makes sense. Yeah. I mean, if you have any thoughts.
Yeah, we look at what the blockchain aspect of what we're building. DEMO stands for Digital Infrastructure for Moving Objects. It's an acronym, and we look at ourselves as building infrastructure to support the next generation of connected vehicles. It needs to reflect the nature of the infrastructure that we have today, which is, there's a standard size for a parking spot or the width of, a train track, and that helps people build equipment that, scales and can be used anywhere. And there's rules like you can't drive 90 miles an hour down a residential road, and those are enforced by existing governments. And really what we're doing is creating a digital overlay that allows people to collaborate a lot more effectively at scale on top of infrastructure that is quite new. And so in our case, like we look at the blockchain's ability, you don't want to prevent yourself from doing something that people will want to do in the future. So starting from a very open position and then overlaying, and one of the things we like to say is that we're trying to turn the DMV and a lot of other government institutions that have control over cars into smart contracts. And so rather than these sort of like arbitrary bureaucratic decisions, you can put everything into code and operate at a much higher scale when these digital assets are making decisions around how they're driving on public roads. And to the extent that blockchains can help us do that, like that's what we're interested in.
Yeah. So, yeah.
Can I add one quick thing?
Yeah, sure.
One thing I am really excited about is the launch of these new exchange chains, if you will. So I think Base is an example of one. Binance Smart Chain, a little bit less so, but there's definitely a future where it could be similar. But to have less friction to onboard users into the RWA space by having chains that adapt the identity from the exchange already, it creates a lot less friction. And
not just from users too, but from institutions. Like putting the DMV on Base would make everyone's life a lot better. And like whether you can argue about their ability to KYC users or whether that's a requirement, but like having those government services exposed as a smart contract on a public blockchain would be a good thing.
Like Polygon has just started their Polygon ID, which is basically linking the KYC of the person on chain. So Polygon ID has already started that project as well. That is also very interesting.
We got WorldCoin too. Pretty soon all of our eyes are going to be zoomed in on chain. So
I see that most of you are staying, like all of you are staying close to the permissionless end. Let's push that end a little further. And like the furthest end is of course Bitcoin. And we keep there's a lot happening there. Lightning Network, DLCs, Taro, Ordinals, and people are trying hard to like make it faster, make it more efficient. Do you see a future where RWAs can actually use that underlying Bitcoin network for what you're trying to do right now?
I can jump in. I think one of the best things about Bitcoin is that it's just Bitcoin. It doesn't necessarily need to have all of this smart contract development to drive value to Bitcoin. Other chains do. And so I think that's a really good use case for Bitcoin. I think what RWA does do for Bitcoin is drive the cost of capital to borrow Bitcoin lower. So today you can basically borrow Bitcoin on chain, pretty much for free. I mean, it's like less than 1% to mint DAI against wrapped Bitcoin. And then on the other hand, you have centralized lenders that are lending against 50% LTV Bitcoin at like 10 to 15%. And why is that? It's just because there's not an efficient capital markets that understands how to underwrite Bitcoin loans. And then also most Bitcoin holders don't feel comfortable holding Bitcoin on ETH. So they're willing to pay that premium. But that's an inefficiency, right? We can create a cheaper cost of capital for centralized Bitcoin lenders to lower the cost of capital for Bitcoin.
Interesting take. Anyone else?
Well, I have been trying to use Lightning networks in Bitcoin, but in the last 10 years that I had been in this industry, the good thing about Bitcoin is that it's just Bitcoin, okay? And I like that. We need something like Bitcoin to be just Bitcoin, no? Because we need the store of value, we need a reference, we need the security of the Bitcoin. So at the end of the day, if we want to transform Bitcoin in something else, I don't know if that is good, okay? But this is my opinion.
More in terms of Bitcoin network, not the Bitcoin currency or...
Well,
yeah.
Okay.
Yeah.
But how can you
Can't really
be
separate
sure
this.
that you will work with the... you will not doing something wrong in the network that maybe change the sense of the Bitcoin. You know, I'm not sure. I think that today the Lightning technology in Bitcoin is not so good.
Yeah.
So maybe in some years we can talk about that.
We'll
But
see,
right now I prefer Bitcoin to be Bitcoin.
We'll talk about it at the Bitcoin Expo 2029. Yeah, okay. We are running over time now. I'll give all of us 30 seconds to say any final words. My final words, which we didn't get to touch upon. I wanted to talk about Fortunafi supporting MakerDAO. And that's a very interesting use case that maybe we can explore some other time about the symbiotic relationship between stablecoins and RWAs. I'm sorry we couldn't touch that today, but that's one of the most exciting thing I find in RWA world happening today. Now I'll ask all my 4 panelists to take like 30 seconds, just like me, and talk about one thing which is either you see it as a big challenge for this space, or it's a really exciting thing about this space, something that you want to talk about.
Me first, okay. We have 10,000 cars connected to Demo today, a little bit under that. It's growing at, last week, grew 9%. And there's about $280 million worth of vehicles on the platform today, and we're opening up a developer platform that lets people create apps and services, finance products, insurance products, accessories, upgrades for vehicles that are all data-driven and part of this user-owned ecosystem. And right now, it's less than 1% of 1% of 1% of cars in the world. And so the thing I'm most excited about is continuing to grow that number and creating this enormous base of things for people to be able to build on top of and plug into better financial services and embrace the composability of what's going on here. And I think we're really hitting a tipping point in terms of developer tooling, and really what we look at is consumer adoption and the ability for somebody to have an easy experience onboarding a vehicle, whether it's with a hardware device or logging into an existing car. And so if you haven't tried it out, download our app and connect your vehicle. We also have hardware that you can purchase, and happy to answer any questions if anybody wants to chat after.
Great. We want other panelists to be little shorter than that. You, Vikas.
Okay. So what I feel for our platform as the biggest challenge is, first of all, ship owning is something which is very much privileged to the ultra-high net worth individuals. And there are not more than 5,000 to 7,000 ship owners across the globe. And we are pushing that envelope using blockchain as a technology to open it for all the people across the globe to invest in this asset class. So that's going to be challenging because we have to educate the people a lot that you can actually own this asset, and it's a very high yield asset. And the second thing is, because shipping is the very traditional industry, the ship owners are very traditional. So making them convinced that you can actually put the vessel more liquid while putting it on our platform. We are going through that challenge, and we are winning that slowly. So that's
Nice.
going to be a process.
I asked you one, you said 2 challenges. So the next 2 speakers, thank you.
Very short. The big challenge for us today and forever is to demonstrate that every time that you transfer a token, you immediately are transferring the property of the real world asset. So this is so difficult that is our main challenge all the time. And if we can demonstrate that, we have a big project. If we cannot demonstrate that, we have nothing. So this is our big challenge.
Thanks.
I'll make it quick, Harsh. Recently, BCG put out a report that stated real-world assets were going to grow to 16 trillion in the next 10 years. We also recently did our own research to backtest that number and came out with double that number in the same time frame. I think one of the biggest challenges is going to be how do we actually solve and build products on-chain that can actually solve this scaling. I think the major answer is going to be liquidity. It's something we've talked about quite a bit here. There is a lot of innovation coming on the liquidity side of things for real-world assets. One thing that I'll point out is stablecoins in particular. I think there's going to be a renaissance of new stablecoin products that'll be built to serve this market and actually allow that total available market size to materialize. So we'll see you in 10 years.
Very exciting. Thank you very much.